All right, let's talk about the language of business, specifically the language of the C-suite. We're going to take all that complicated financial jargon you hear in meetings and turn it into simple, powerful tools that you can actually use. So, let's get right into it. You know that feeling, right? The conversation suddenly turns to finance and it feels like everyone else is speaking a different language. Words like EBITDA and IRR get thrown around and you're just nodding along, hoping nobody asks you a direct question. Well, don't worry. In the next few minutes, we're going to give you the key terms you need to jump into that conversation with total confidence. First things first, we've got to follow the money. And honestly, the best way to understand profit is to picture a giant funnel. A really big number goes in at the top, and as we move down, we start subtracting different costs, which leaves us with different and way more meaningful kinds of profit. So, at the very top of our funnel, we have revenue. This is that big, flashy number you always hear about. It's all the money a company brings in from sales before a single penny in costs is taken out. So, if a coffee shop sells 100 cups of coffee at $5 each, their revenue is $500. It's really as simple as that. But here's the thing. A huge revenue number can be super misleading. I mean, a company can sell millions of dollars worth of stuff and still be losing money if its costs are out of control. And that's exactly why we have to follow that cash down the funnel to see what's really going on under the hood. Our first stop down is gross profit. To get here, we take our total revenue and subtract something called the cost of goods sold, or COGS, as you'll hear it called. Just think of COGS as the direct cost of making what you sell. So for our coffee shop, that's the coffee beans, the milk, the cups. What's left over tells you how profitable your actual product is before you even think about paying for marketing or rent. Go a little deeper down the funnel, and you hit operating margin. Now this is a really crucial health check for the business itself. After we subtract all the operating costs, things like marketing, salaries, research and development, what's left shows us just how efficiently the company runs its main day-to-day operations. You see, a healthy operating margin means the core business is basically a well-oiled machine. And now for a really famous one, EBITDA. That's a mouthful, I know. It stands for earnings before interest, taxes, depreciation, and amortization. It's basically a way to look at a company's performance without all the noise from accounting rules and financing decisions. It's really all about the raw cash-generating power of the business's operations. So why do investors and bankers love this metric so much? It's pretty simple, actually. It's widely seen as the best way to measure a company's ability to take on debt and, more importantly, pay it back. A high and steady EBITDA signals that the company is a cash-generating powerhouse, which makes it a much, much safer bet for anyone lending it money. All right, so we've just looked at how to measure profit from what's already happened. Now let's totally switch gears and look at the tools people use to decide if a future investment is a good idea. Welcome to the Investor's Toolkit. Okay. Two of the most common tools you'll hear about are payback and IRR. You can almost think of them as two sides of the same coin. Payback is super simple, and it asks a very direct question. How fast do we get our initial investment back? IRR, on the other hand, is more complex, but it gives a much more precise answer to a different question. What is the true percentage return of this investment over its whole life? Let's start with payback. The beauty of this one is its simplicity. If you spend $1 million on a new machine and that machine brings in an extra $250,000 a year, your payback period is 4 years. Boom, done. Executives love this metric because it's so easy to understand and gives them a really quick feel for the risk involved. Now, IRR is kind of like payback's more sophisticated older sibling. It looks at all the cash flows, both in and out, over an investment's entire life and boils it all down to one powerful number: an annual percentage return. So if your company has a rule not to approve any project that returns less than 10%, that's what they call a hurdle rate, and your project's IRR comes in at 15%, well, you've got yourself a green light. But, and this is a big but, there's a catch with IRR. It is fantastic as a filter, to decide if a project is even worth considering in the first place. But it should not be used to rank projects against each other. And why is that? Because small differences in when the cash comes in can totally skew the results, making it an unreliable tool for comparison. So the key takeaway here is use IRR to screen projects, not to rank them. And this idea of an expected return is incredibly versatile. In fact, when you apply the same logic of IRR to a company's stock, you get something called the implied cost of capital. It's just a fancy way of figuring out the return that the stock market is expecting or demanding from that company based on its current share price and what people think it'll do in the future. Okay, for our last big concept, we're going to zoom out from looking at single projects and look at the company's entire financial structure. This is all about a really crucial balancing act, the one between debt and ownership.
So what does a number like this, 1.5, tell you about a company? Is it risky? Is it safe? Well, on its own, it's really just a number. But when you put it in context, it tells a massive story about how a company is built. Let's see how. That number represents the debt-to-equity ratio. It simply compares how much money a company has borrowed to how much money its owners have put in. A ratio of 1.5 literally means the company has $1.50 in debt for every $1 of its own money, or equity. Now, a higher ratio can definitely mean higher risk, but it can also juice up the potential returns for the owners. It's a critical balancing act every company has to manage. Okay, we've gone through all the key terms, but now comes the most important part. Let's put it all together and actually apply it. It's time to step into the shoes of a chief financial officer for a minute. Imagine your CFO says this in a meeting. Now you know exactly what they're talking about. Margins are compressed tells you there's a problem with your operating margin. Your core business just isn't as profitable as it needs to be. And debt is high points directly to that debt-to-equity ratio, signaling that the company might be carrying too much financial risk. See, you're already speaking the language. So here's the final challenge for you. Knowing what you know now, how would you respond to that CFO if you were proposing a new solution, like a Siemens software subscription? How could you frame it using their language? Think about it. Could your idea actually help improve those compressed margins? Could it generate the kind of cash that gives the company more flexibility to handle its high debt? Being able to answer those questions, that is the real power of unlocking the CFO's language.